Welcome to Iron Financial, the only place where we forge stronger portfolios by stress testing market narratives. Today, we're putting Gambling.com Group, ticker GAMB, under the microscope. This is a company caught in a brutal tug-of-war between its past performance and its future potential.
And that's the whole story right there. The market has absolutely hammered this stock, wiping out 2/3 of its value. Yet Wall Street analysts are telling you it could nearly double from here. One of these sides is dead wrong. Our job today is to figure out which one, and whether this is an opportunity or a trap.
Okay, let's dive into this. We've structured our analysis to get to the truth. We'll start with the battlefield view of the stock, then build the bull case, the story management wants you to hear. After that, we'll bring in the wrecking ball and look for every crack in the armor, including a critical red flag buried deep in their financial filings. Finally, we'll weigh the evidence and deliver the iron financial verdict.
A brawler is one word for it. Looking at this chart, it seems more like a knockout victim. The stock is trading just a breath away from its 52-week low. For a full year, the sellers have been in complete control.
Now, what's really interesting about this slide is just how close we are to the absolute bottom. Down 66% in a year, down over 72% from its high. The sentiment here is toxic, so I have to ask, why are we even wasting our time inspecting this rubble?
Because professionals who get paid to analyze this company see a completely different picture. We have 6 buy ratings and only 2 holds against 0 sells. The median price target of $8 implies a 94.6% upside. The high target from Stifel's analyst suggests a staggering 192% run. That's not a small disagreement. That's a fundamental disconnect between market price and perceived value. So the crucial point is the market missing a massive turnaround, or are the analysts blind to a fatal flaw? Let's build their case.
To understand the bull case, you have to look past the stock price and drill down into the Q4 2025 earnings report. Management is trying to tell a story of a strategic pivot, and the numbers, on the surface, look strong.
First, the top line. A record $46.2 million in fourth quarter revenue. This is the highest in the company's history.
And this isn't just a small beat. That's 31% growth compared to the same quarter last year. In this economic environment, 31% top-line growth is a heavy-duty number that demands attention.
And they delivered on the bottom line, too. EPS came in at $0.30, crushing the forecast of $0.21. That's a nearly 43% positive surprise. So you have a company growing the top line by over 30% and smashing earnings estimates. This is the foundation of the bull thesis. But the real story is how they're getting that growth. And this brilliantly illustrates the pivot. CEO Charles Gillespie highlights it right here. They are moving away from being purely a performance marketing company, which relies on things like search engine rankings, and building a new pillar, a high-margin, subscription-based sports data business. Growing that segment 440% in a year is a monumental shift.
This is what that new foundation looks like. A year ago, that blue slice was negligible. Now, sports data services account for over a quarter of the entire business. This is a more resilient, recurring revenue model. It's exactly the kind of strategic shift that long-term investors should be looking for, a solid growth story built on a new, stronger business line.
That's a great story. It's a shiny press release. But the market isn't a storybook, it's a weighing machine. And when the market weighed these results, it sold off. The stock dropped 4.59% in pre-market trading after this great report. Why? Because when you look past the hand-picked headlines, you find some serious cracks in this new foundation. Let's start with that record revenue. Yes, it was a record, but it was also a miss. Wall Street expected more. It's a small miss, just 2.3%, but it signals that the growth momentum might be slowing. More importantly, it's what management said about the future that spooked investors.
Now, what's really interesting about this slide is the gap. Before this earnings report, analysts thought GAMB would do nearly $190 million in revenue in 2026. Management came out and guided to a range where the high end, $180 million, is still well below what the street was hoping for. That's not a sign of confidence. That's a warning shot.
But this is the number that really hurts. The cost to achieve that revenue growth is getting punishingly high. The adjusted EBITDA margin collapsed from 42% down to 33% in just 1 year. That's a 9-point drop. It tells you they're spending a lot more money for every dollar of growth. So the crucial point is, they're selling you a story of a high-margin data business, but the overall profitability of the company is weakening significantly. The structure is getting heavier, but the pillars supporting it are getting thinner.
I'll concede the guidance was weak and the margin compression is a concern. Those are headwinds. But what you found is more than a headwind. It's a structural integrity issue. This goes beyond one bad quarter.
Exactly. This is where we stop looking at the earnings transcript and start digging into the official SEC filings, the documents with legal weight, specifically the company's 20F annual report. And buried inside is something every investor needs to see.
Before I show you the quote, we need to define this term. A material weakness is not a small accounting error. It is a foundational flaw. It's the corporate equivalent of an engineer telling you the concrete in your building's foundation might be defective. It means the company admits it has a serious problem with its ability to report its own financial results accurately.
And this is the exact language from their filing. The material weakness is specifically in their controls over revenue recognition. This is the most critical line item for a growing company. They are telling regulators and us that they have a flaw in the process they use to count their sales. This isn't a crack in the armor. This is a flaw in the bedrock the entire structure is built on.
The consequences here are severe. First, how can you trust the revenue growth or the EPS beat when the company itself admits its controls for accounting revenue are ineffective? Second, this raises the risk that they might have to restate their financials in the future, which is a death blow to a stock. And third, it shows a fundamental lack of operational control at the most basic level of being a public company.
Okay, let's put it all on the scales. You can't ignore the material weakness. It's the single biggest risk factor here, and it taints the entire bull case. Any analysis that doesn't start and end with that fact is incomplete. However, you also can't ignore that the strategic pivot into data services is real and generating explosive growth. And this brilliantly illustrates the conflict. Every single point in the bull column is undermined by the points in the rest column. How much is that record revenue worth if their controls for recognizing it are flawed? What good is crushing EPS estimates if profitability is collapsing? And who cares about analyst price targets if the underlying data those analysts are using could be unreliable? The risk side of this table doesn't just balance the reward side, it actively attacks its credibility.
So, where does that leave us? This is not a simple case of an undervalued growth company. This is a high-stakes bet on management's ability to fix a fundamental operational flaw while simultaneously executing a difficult business pivot in the face of regulatory headwinds. The bull case requires you to believe that the data services growth engine is so powerful it will overcome the drag of a broken accounting chassis.
The bear case is simpler. The foundation is unsound. Until the material weakness is fully and verifiably remediated, everything built on top of it is at risk of collapse. The growth story is irrelevant if you can't trust the numbers. It's a house of cards standing on shaky ground.
So the crucial point for every investor watching is this. Gambling.com Group presents a powerful engine of growth bolted to a frame with a disclosed structural defect. The potential reward is high, but the risk of a catastrophic failure is not zero. You have to decide if your portfolio is built to withstand that kind of risk. That's our analysis. Now it's up to you to forge your own verdict. For Iron Financial, we're out.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.